In this video, you're going to understand something most people never realize. Banks do not need you to borrow money to profit from you. Most people believe banks make money from loans, mortgages, car loans, credit cards. That's what we see, that's what we're told. But that's only the visible layer. The real system is quieter, more consistent, and far more powerful. And once you see it, you won't look at your bank account the same way again. Imagine Jack. He earns $5,000 a month. He doesn't have a mortgage. He doesn't carry credit card debt. He avoids loans. He gets paid, pays his rent, covers groceries, subscriptions, gas, utilities, maybe invests a little, and keeps the remaining balance in his checking account. If you asked most people, they'd say Jack isn't very profitable for a bank. No debt means no interest payments. No interest payments means no revenue. Sounds logical. It's also completely wrong. The moment Jack's salary hits his account, something happens behind the scenes. That deposit is not cash sitting idle in a vault. On the bank's books, it is recorded as a liability, yes, but operationally it becomes part of a massive pool of aggregated deposits collected from millions of customers just like him. Jack sees his balance, the bank sees liquidity, and here is the first key idea. Jack will not spend that $5,000 immediately. Some of it will sit there for days, some for weeks. Some might sit there indefinitely. That idle portion is called float. Individually it looks small, collectively it becomes enormous. When millions of people leave a few $1,000s sitting in checking accounts, that creates billions in stable, predictable capital. And this is where the real system begins. Banks operate under a fractional reserve framework. They are required to keep only a portion of deposits readily available for withdrawals. The rest can be deployed, not recklessly, not secretly, but strategically. If Jack deposits $5,000, the bank doesn't need to keep all $5,000 frozen. It keeps a required reserve buffer and the rest becomes usable liquidity. And here's where most people have their aha moment. The bank does not need Jack to take a loan to earn from his money. It just needs him to leave it there, because that idle balance is fuel for multiple revenue engines that have nothing to do with consumer lending. One of those engines is the interbank market. At the end of every business day, banks settle balances with one another. Some banks end up with excess reserves. Others face short-term shortfalls, so they lend to each other, often overnight. These are extremely short-duration loans, sometimes lasting only hours. The interest rate might look tiny on paper, but when billions move daily, small percentages compound into substantial income. Part of Jack's unused balance can quietly circulate through this system while he sleeps. By morning, the money is back, fully available in his account. He never notices, but the bank has earned from it. This happens every day. Then there is the central bank layer. Commercial banks can hold reserves at the central bank and, in many systems, earn interest on those balances. That means even excess liquidity that isn't lent to other banks can generate predictable, low-risk income. Stability is not just protection, it's part of the business model. But we're not done, because deposits are only one side of the machine. The second engine is payments. Every time Jack taps his debit card to buy coffee, an invisible chain reaction begins. The merchant's terminal sends a request through a payment network to Jack's bank. The bank verifies the funds, approves the transaction, and settlement follows. The merchant pays a fee for that service. That fee is split between the payment network and participating banks. It might only be a couple of cents per transaction. That sounds insignificant until you multiply it by billions of transactions every single day. Jack buys lunch. He fills his gas tank. He pays for streaming services. He orders online. Each action generates micro-revenue. The bank does not need high margins, it needs volume, and the volume is relentless. Direct deposits, automatic clearinghouse transfers, bill payments, subscription renewals, peer-to-peer transfers. Every movement flows across financial rails that generate fees. The bank doesn't manufacture products, it owns the infrastructure. It is the toll operator on the financial highway, and as long as economic activity continues, those tolls keep flowing. Now let's add another layer, Treasury operations. Banks do not let stable deposit pools sit unused. They manage them through internal investment divisions. One of the safest destinations for excess liquidity is government bonds. When a bank purchases government debt, it earns steady interest payments. If Jack's checking account earns little or nothing, the difference between what the bank earns on those bonds and what it pays Jack becomes spread income. That spread is predictable. In accounts paying zero interest, nearly the entire yield becomes profit. This is why banks prefer stable depositors. A customer like Jack, predictable, consistent, not constantly draining large sums, is extremely valuable. Because predictability allows banks to model behavior at scale. Across millions of customers, they can forecast daily liquidity needs with surprising accuracy. They know roughly how much money will leave the system tomorrow. They know roughly how much will stay. That forecasting ability allows them to deploy capital confidently without compromising stability. And here's the second interesting moment. The bank's most valuable customers are not necessarily the ones paying the most interest. They are the ones creating stable patterns. Stability reduces risk. Reduced risk increases deployable capital. Deployable capital increases income. Now step back and look at the structure. High capital requirements and regulatory frameworks create strong barriers to entry. Starting a bank requires enormous capital, compliance systems, and ongoing supervision. Deposit insurance builds public trust, encouraging people like Jack to keep their money in the system. Regulations designed for safety also reinforce durability. They formalize the rules under which banks operate and profit. Even in periods when loan demand slows down, the machine does not stop. Payment processing continues. Interbank balancing continues. Treasury income continues. Government bonds continue paying interest. Economic activity does not require consumer borrowing to function. It requires money movement. And money movement is where the infrastructure earns. Loans are visible. Infrastructure is foundational. Most people focus on interest rates. Banks focus on velocity, aggregation, and predictability. The system is not built around convincing you to borrow. It is built around ensuring your money flows through channels they control. That is the hidden architecture. And once you understand this, your perspective shifts. Your checking account is not just storage. It is participation. Your debit card is not just convenience. It is integration. Your salary deposit is not passive. It is fuel. Do you think this system is fair? Comment yes or no. Most people never understand how these systems work. If you don't want to be one of them, subscribe.